Getting a client approved for non-contingent financing is one way for a current homeowner to buy their next home without having a sale in place on their current home. In a competitive seller's market like we have here in the Portland area, this can mean the difference between you getting your next home or simply having your offer rejected because it was contingent upon selling your home. To learn more about how to become approved for non-contingent financing, I reached out to Jeff Naylor, senior mortgage banker with Summit Mortgage Company. Jeff is an expert on this type of financing. Hi, Jeff.
Hey, Tom.
So, Jeff, we're in a really competitive seller's market here in the Portland area, and it can be a real challenge for a homeowner that needs to sell their home in order to buy their next home. Is it possible for them to obtain financing that will allow them to purchase their next home without selling and paying off their existing mortgage and positioning them to be what is a non-contingent buyer in our market?
You know, that's a great question, Tom. And yes, we can get buyers approved for non-contingent financing. It's really just a balancing act. The key is to kind of get the buyer approved for those two mortgages at the time that they purchase that new home. Every situation is unique, but for me, what I'm going to do is I'm going to look at what kind of resources that buyer brings to the table before selling. Do they already have a down payment in place without having to tap into that equity? Do they have a home equity line of credit already on their current home, or do they have enough equity to put that on if we need to tap into that for the down payment? Really, the key is, like I said, it's just a balancing act. We need to qualify that buyer with those two mortgages and use those resources for the down payment. And then at the same time, we need to stay at or under that max debt to income level that the agencies allow.
So the good news is this is achievable for a buyer in our market. Does it matter which lender and which loan officer you're working with? And what do you and Summit Mortgage do in particular to help position the buyer to be a non-contingent buyer in our market?
You know, Tom, absolutely. Like I said before, it can be a challenging balancing act. You know, when you're working with a loan officer, you want to make sure that that loan officer has a lot of experience with these types of pre-approvals. Personally, you know, I really enjoy the challenge when we're in that kind of position and we're looking to get that kind of pre-approval. And luckily for me at Summit Mortgage, we don't really have any debt to income ratio overlays. So what that means is that we can actually underwrite to the maximum of what Fannie Mae, Freddie Mac, FHA, or VA will allow. The fact that the buyer in this case is more than likely to be selling their home, you know, 2-3 months down the road. So that actually is a compensating factor to justify those higher debt to income ratios.
Okay, Jeff, that sounds good for a traditional buyer, but what about someone who might be self-employed, a business owner, or maybe even they've experienced some credit challenges? Can you still make this type of financing happen for that person?
Yeah, also a great question, Tom. When it comes to business owners, we're going to have to get a income number on their application just like any other buyer. The difference is we're going to be looking at that through different means. We're going to be looking at their last 2 years of federal income taxes. We're going to be probably needing to look at their business taxes if they have 25% or more of ownership in that business. For me, there's a couple strategies that I use to try to get the most out of those filings in order to maximize what we can do with their buying power. When it comes to the buyers that have maybe had some credit challenges over the past few years, we're going to be looking at a different type of financing for them most likely. They will probably work best with FHA government financing. The reason this financing works well is because the underwriting criteria is much more flexible when it comes to, you know, credit and also debt to income ratios. So let's say we have a buyer with, you know, a mid to low 600s credit score. We can still get them that non-contingent pre-approval in order to get into that next home.